You're watching what looks like a historic rally in silver, a metal that hasn't reached these levels in over 4 decades. You see prices climbing past old highs, headlines praising the bull market, and commentators saying this could be the next big surge. Then suddenly, the price crashes. Not because traders panicked, not because the market suddenly turned bearish, but because something behind the scenes changed the rules of the game. This is not fantasy. This is what actually happened in late 2025, and if you don't understand the dynamics, it can look like the market is rigged against everyday participants. Let's start with the basics, because context matters. Silver, like gold and other commodities, is traded in 2 main ways. There is the physical market, bullion bars, coins, and spot trading, and there is the paper market, where futures contracts are bought and sold, often without the intention of ever taking physical delivery. The most widely followed paper market for silver futures is run by the CME group on the COMEX exchange in New York, which sets a benchmark price that influences markets worldwide. In 2025, silver's price went on an extraordinary run. The metal, which had spent years mostly below $30 per ounce, began rising rapidly in the first half of the year, pushed by a combination of factors including expectations of lower interest rates, increased investor attention on precious metals, and concerns about inflation and global economic uncertainty. By late December, silver's price had reached an all-time high of about $83.90 per ounce on the futures market, the highest nominal price ever recorded. Then came a dramatic reversal. On December 29th and 30th, 2025, silver futures plunged sharply, in some sessions dropping more than 10% in a single day, shortly after the CME group announced increases to margin requirements on silver futures contracts. Margin requirements are amounts of cash or collateral that traders must hold to maintain their open positions. When margins rise, traders need more capital to hold the same number of contracts. If they can't provide it, their positions can be closed automatically by brokers or exchanges, leading to forced selling. The CME's decision to hike margins was framed as a response to the extraordinary volatility in precious metals markets, and exchanges regularly adjust margins to control risk and ensure that traders can cover potential losses. In late December, the CME raised initial margins for silver futures multiple times within a few days, significantly increasing the cash required to hold positions. These adjustments drained liquidity and made leveraged positions harder to maintain, contributing to selling pressure on the futures price. This sequence of margin hikes happened against the backdrop of thin holiday trading volumes, which often occurs between Christmas and New Year's Eve when many market participants are out of the market. Thin liquidity can exaggerate price moves because there are fewer buyers and sellers available to absorb large orders. The combination of rising margins and reduced liquidity accelerated the price decline. It's important to understand that what happened in the futures market is a market mechanism designed to manage risk, not a conspiracy. Exchanges like the CME adjust margin requirements based on data, including price volatility and historical moves. Higher volatility generally leads to higher margins because traders are more likely to experience rapid losses. When margins go up quickly, traders who are leveraged, meaning they have borrowed money to hold larger positions, may face forced liquidation if they don't have additional capital. Still, when you see a sharp drop in the futures price after a record rally, it can feel counterintuitive, especially if you're holding physical silver or planning to buy it. But price behavior in the paper market is not always the same as in the physical market. Futures prices can be influenced by technical factors, leverage, and exchange rules, whereas physical silver prices tend to reflect supply and demand for actual metal, which can behave differently in times of stress or market dislocation. Looking back in history, silver has already shown sharp corrections following major rallies. One of the most famous incidents was Silver Thursday in 1980, when the Hunt brothers attempted to corner the market, pushing prices dramatically higher only to see a catastrophic collapse that wiped out leveraged positions when margin calls came due. On March 27, 1980, prices plunged after traders failed to meet margin requirements, triggering widespread forced selling. In 2011, silver again saw a peak near $49 per ounce after years of rising prices, followed by a steep decline in the months that followed. During that period, a series of stronger margin requirements and broader market conditions contributed to a correction that wiped out many leveraged traders and brought prices down significantly from their highs. These historical examples show that spikes in margin requirements can coincide with major turning points in price action, particularly in leveraged markets where participants are sensitive to changes in financing conditions. History does not repeat exactly, but it often rhymes, and patterns in how futures markets respond to rule changes or risk management decisions tend to recur. Another key point is that silver is not just a speculative asset. It is also an industrial metal with real demand in sectors like solar energy, electronics, electric vehicles, and data centers. This demand comes from its unique physical properties, such as high electrical conductivity, which make it essential in photovoltaic cells, connectors, and other technologies. While industrial demand doesn't determine short-term price movements, it does add a structural support in the longer term. Physical silver markets have their own dynamics. In recent years, demand for physical bullion has increased in some regions, partly driven by concerns about macroeconomic uncertainty and a desire to hold tangible assets. In some cases, premiums, the amount buyers pay above the quoted spot price to obtain physical metal, have risen, indicating strong physical demand even when paper prices are volatile. However, premiums and physical shortages can vary widely by region and over time, and physical market conditions are not always perfectly in sync with futures market prices. When explaining price movements, it's also worth noting that short-term drawdowns, even sharp ones, are a normal part of commodity markets. Commodities like silver are historically more volatile than equities or bonds, meaning their prices can swing widely in both directions based on shifts in supply, demand, monetary policy expectations, currency fluctuations, and broader market sentiment. Silver's role as both an industrial and a precious metal contributes to that volatility because different forces can influence its price at the same time. It's also valuable to distinguish between paper prices and physical supply fundamentals. Commodities, analysts often point out that futures markets may be very liquid and large relative to the actual physical inventories that exist at delivery points. In some markets, the number of outstanding futures contracts can far exceed the deliverable physical supply, leading to large paper-to-physical ratios. This does not mean physical silver is running out globally, but it does illustrate that futures prices can sometimes diverge from physical market conditions. The recent sharp moves in silver illustrate how futures markets, technical forces, margin rules, and liquidity conditions can produce rapid price changes that may not fully reflect underlying physical demand or supply. These dynamics are especially pronounced when prices have risen rapidly and then encounter increased risk controls like margin hikes. Recognizing these differences helps explain why silver's price in the paper market can retreat even when long-term fundamentals or industrial demand remain strong. So, what's the big takeaway? Silver's price is shaped by many factors, from exchange-level margin requirements and trading mechanics to broader macroeconomic sentiment and industrial demand. A futures market correction is not evidence that the metal itself has suddenly lost value in the physical world. Instead, it reflects the way leveraged markets function when risk conditions shift. In other words, the recent price drop following record highs was largely a technical adjustment in the context of a very strong rally rather than a definitive collapse of silver's long-term prospects. The lesson is not to blame a single institution or actor, but to understand that futures markets and physical markets behave differently, and that price can be volatile when markets are driven by speculative positioning, risk management actions, and liquidity conditions near key calendar events. Markets will always have volatility. That's part of their nature. What matters is understanding the mechanics behind the moves, how changes in margin requirements affect leverage positions, and how physical and paper markets interact. In the case of silver, we are seeing a dramatic rally and a sharp correction, a pattern that commodity markets have experienced before. By knowing the difference between technical price moves and fundamental market forces, you can interpret what's happening without falling into fear or misinformation.